All right, welcome to Iron Financial. This is the show where we forge stronger portfolios by putting market stories under the microscope, by really stress testing them. I'm your lead analyst, and I'm here with our market skeptic. Today, we've got Moody's Corporation on the anvil. You see, their Q1 earnings just hit the street, and if you just read the headlines, you'd think they built an untouchable financial fortress. We're talking record results, just glowing reports. But here's the thing. The market? It's not buying it. Not one bit. The stock is actually getting crushed. And that, right there, that's the kind of puzzle we love to solve. So what's the real story? Is Wall Street completely asleep, just missing a huge opportunity here? Or are they sniffing out some deep, ugly cracks in the foundation, cracks that maybe the C-suite's trying to hide? We're going to tear this thing apart, look at the numbers, and figure out if Moody's is a fortress of steel or just a house of cards. Okay, so let's get right into the central problem here, because this is where everything's at. This is where you either find the opportunity or you walk right into a trap. So on one side, you've got the company's story, the official line, the big, bold headline, record results. They are shouting from the rooftops about all-time highs in their main ratings business, fantastic top-line growth, better margins, the kind of stuff that should have investors celebrating. But then you look at the other side. You look at what the market is actually doing. And the stock, MCO, is telling a totally different story. It's not just lagging a little bit, it's getting punished, seriously underperforming. So whenever you see a company's story and its stock price moving in opposite directions like this, it can only mean one of two things. Either the market is completely wrong and the company is a huge bargain, or the market sees a storm coming that the company isn't talking about.
Yeah, and analyst, this chart, this says it all, doesn't it? This isn't some small gap we're talking about. Look at this. Moody's stock, MCO, is down a whopping 10% this year. 10% in the red. Now compare that to the S&P 500, which is up over 3%. So you do the math, that's a 13-point difference. That's not just a gap, that's a canyon. And a gap that wide isn't just market noise, it's a giant blaring alarm bell. The market is screaming that something is fundamentally wrong here. So you tell me, if the engine is running so hot, why is every smart investor I know running for the door? Are they seeing a collapse coming that we're not? Or is a good company just getting beaten up for no reason? That's the question we have to answer, right?
That's exactly right. You've just laid out the battle lines perfectly. Is the market just missing something here? Are they so focused on the wrong thing that they're ignoring amazing fundamentals, which would make this a golden opportunity for anyone paying attention? Or is this stock performance a huge red flag? A signal that the party is about to end, and end badly. We are absolutely going to get to the bottom of it. So here's our game plan. I'm going to start. I'm going to build the strongest bull case possible. I'll use their own numbers, their own data to construct this financial fortress you've heard so much about. Then, when I'm done, it's your turn. You're going to come in and try to find the cracks, try to knock it down. Let's do this.
All right, let's start construction. We're going to build this fortress piece by piece, and we're only using the hard data from their Q1 report. So the bull argument, the case for buying, is that this business isn't just humming along, it's actually getting stronger. It's generating real, massive value for the people who own the stock. And this isn't some pie-in-the-sky story about what might happen in 5 years. This is about what's happening right now. The numbers are undeniable, and they show a company with incredible financial strength that, for some reason, the market is choosing to ignore. Let's start right at the top, with revenue. So the very first pillar of the foundation of this whole thing is revenue growth. $2.1 billion. That's a huge number for just one quarter. But the number itself isn't even the most important part, it's the growth. That's an 8% jump compared to this time last year. Now think about the current economy. A lot of companies are just trying to tread water. So for a huge, established company like Moody's to be growing at 8%, that is some serious strength. It tells you that people need what they're selling. The demand for their ratings, their data, it's not just holding steady, it's growing. This isn't weak growth. It's solid, powerful expansion that shows the core of their business is really, really healthy. Okay, so that's the money coming in the door. Now, what's even more impressive is how much of that money is making its way down to the bottom line, the part that actually matters to shareholders. This 13% you're looking at, that's the growth in their adjusted earnings per share, which came in at a monster $4.33. This is what we call operating leverage, and it's beautiful to see. It means they're getting more efficient. As more revenue comes in, they're keeping more and more of it as pure profit. They're managing their business well, they're scaling up, and it's just dropping cash right to the bottom line. So this isn't just any growth, it's the really good kind. Super profitable growth that makes owners of the stock richer. And if you want to know what management really thinks about their company's future, you don't listen to their words, you watch what they do with their money. And boy, did they make a statement. They didn't just say they'd buy back some stock, they raised their plan for the whole year to a massive $2.5 billion. That's half a billion more than they were planning. Now look, a company's board doesn't sign off on a buyback that big unless they are absolutely certain about two things. One, they think their stock is dirt cheap. And two, they know they have a fire hose of cash coming in to pay for it without even blinking. This is management walking the walk. It's the clearest signal of confidence you could possibly ask for. And hey, you don't even have to take my analysis for it. Just listen to the CEO, Rob Fober himself. He said, and I quote, "Both MIS and MA delivered strong results with sustained growth and powerful operating leverage." He's basically giving you the entire bull case in one sentence. He's hitting on those two exact points: sustained growth on the top line and that powerful leverage that turns it into profit on the bottom line. And just so we're clear, MIS is Moody's Investor Service. That's their legendary ratings agency. And MA is Moody's Analytics. That's their data and software business. So the CEO is making it plain as day. This isn't just one part of the company doing well. The strength is everywhere. Both of their main engines are firing. And this table right here, this breaks it all down. And the numbers are they're incredible. So you've got the two big divisions, MIS and MA. Now just look at that yo-yo growth column. It's perfectly balanced. MIS brought in $1.15 billion, up 8%. MA brought in $926 million, and it's also up exactly 8%. It's like they're perfectly in sync, both engines pushing forward with the exact same power. Now slide your eyes over to the adjusted op margin column. This is where it gets crazy. MIS is basically a license to print money, a 67% margin. That means 2/3 of their revenue is pure profit. And MA is no slouch either, with its own very healthy margin of over 32%. This isn't a story of one strong business carrying a weak one. This is a balanced, powerful machine firing on all cylinders. So, what was the rocket fuel behind that incredible ratings business? Well, here it is. This is the big one. For the very first time ever, the total amount of debt that MIS rated in just 3 months blew past $2 trillion. I mean, just try to wrap your head around that number. It is a stunning, record-breaking figure. This is their oldest, most core business, and it is firing on all cylinders like never before. And the company told us exactly why. Companies were borrowing money at a near-record pace, especially for big AI projects, which was over $100 billion by itself. It shows they are right in the middle of the biggest trends shaping the economy. So there's your bull case, a true financial fortress, record revenue, huge profits, and a management team that's all in. It seems bulletproof. Okay, hold on a second, analyst. That's a great story. It really is. You've painted a picture of this perfect, shiny fortress based on one single quarter, where the sun was shining. But I'm not buying it. You know, a good engineer doesn't check a building's strength on a nice day. They test it for an earthquake, for a hurricane. And a fortress built on something as shaky as financial markets is only as good as its foundation. And frankly, I think this foundation is built on quicksand. The market isn't dumb, analyst. If a stock with numbers this good is selling off hard, it's because the market is looking past the paint job and seeing the rust underneath. It's time we did too. And that brings us right back to the only question that actually matters here. If this company is so rock solid, why is the market running away from it like it's on fire? You have to remember, the stock price is always looking forward. It's a bet on the future. And right now, the market is placing a huge bet against Moody's. It's not pricing in the fantastic quarter they just had. It's pricing in the bad quarters it thinks are just around the corner. The market thinks that $2 trillion in issuance wasn't a new normal, it was the peak. It thinks the good economic conditions that helped them in Q1 are about to disappear. The market is pricing in risk, and my job is to find exactly where that risk is hiding. All right, let's start peeling back the onion using the very same numbers you were just bragging about. You cheered for that 8% growth in Moody's Analytics, but you kind of glossed over where that growth came from. So let's break it down. MA has two kinds of revenue. You've got the steady, recurring revenue from subscriptions. And yeah, that was up a nice 11%. I'll give you that. That's solid. But look at the other part, the transactional revenue. It didn't just go down. It fell off a cliff. It's down 54%. Now, you can spin that however you want, but a number like that is a shock to the system. That's not a pivot. That's a part of your business getting vaporized. It shows some serious weakness in a key area, and it makes me wonder, is that subscription growth really strong enough to paper over cracks that big? And this right here, analyst, this is the storm on the horizon. And don't try to tell me this is just me being negative. This list of headwinds, this comes directly from Moody's own report. This is what they're telling us is coming. They expect it's going to get riskier and more expensive for companies to borrow money. That's poison for their ratings business. They see unemployment going up, which hurts everyone. They're pointing to geopolitical risk, trade wars. I mean, read the list. These are not the ingredients for another record-breaking quarter. This is the recipe for a major slowdown. The market sees this, and it's saying that the perfect weather they had in Q1 is about to end, and a big storm is rolling in.
And this right here, analyst, is the smoking gun. This is the piece of the puzzle that the bulls just want to pretend doesn't exist. Look, it's simple. When you have a quarter this good, when you absolutely crush expectations like they did, what's the normal move? You raise your guidance for the rest of the year. It's management 101. You tell the street, hey, we're doing even better than we thought. But what did Moody's do? Nothing. They beat on revenue, they beat on earnings, and then they just left their full year forecast exactly where it was. What is that telling you? To me, it's screaming that management themselves don't believe this is real. They think Q1 was a fluke, a one-off. They're basically whispering to the market, don't get used to this, folks. So if the people running the company don't believe the hype, why on earth should any of us? Skeptic, your whole argument is stuck in the past. You're fighting yesterday's battle. You're obsessed with a part of the business they are deliberately moving away from. And you're worried about economic cycles that affect the old Moody's. You're completely missing the bigger picture. The company is rebuilding its entire foundation. They're forging a whole new engine for growth, one that's designed to withstand these storms, one that doesn't depend on whether the bond market is hot or cold. The market's fear is tied to an old business model. The real opportunity is in the future they are building as we speak, a future built on the solid steel of recurring revenue.
So to really get this, you have to understand this one metric, ARR, annual recurring revenue. This is not the one-time fee you get for rating a bond, which can vanish overnight if the market gets choppy. No, this is the value of sticky, long-term contracts for data and software that customers have to have. They pay for it month after month, year after year, no matter what the economy is doing. It's predictable, it's stable, and it's the foundation of any modern data company. And it is the absolute core of the new Moody's Analytics. At the end of the first quarter, their ARR was $3.6 billion, up a very healthy 8%. That number tells you the real health of the company, and it points to where the future growth is going to come from.
And this chart right here just completely dismantles your point about that 54% drop in transactional business. It's a total distraction. You're yelling about a crack in the sidewalk while they're building a skyscraper next to you. Just look at the revenue mix for Moody's Analytics today. 98% of it, 98, comes from that stable recurring revenue I was just talking about. That other business that collapsed that you're so worried about, it's only 2% of the entire division. Of course it's shrinking. They're getting rid of it on purpose to focus on the 98% that's stable and growing. The market is freaking out about the 2%, while the company is building an indestructible business with the other 98. It is a classic case of not seeing the forest for the trees.
Okay. So what's going to make that 98% grow even faster? This right here is the next chapter. Moody's isn't just selling data anymore. They are weaving their insights and tools right into the daily workflow of the biggest companies in the world, using AI. Their intelligence is now available directly inside enterprise versions of ChatGPT, inside Claude, you can get it on the AWS Marketplace, and it's even plugged into Microsoft 365 Copilot. Think about what that means. They are putting their product directly in the hands of millions of new users without having to do much at all. It's a brilliant move that creates a whole new, super scalable way for them to make money and drive that ARR number for years to come. This is the new engine, and the market isn't paying any attention to it.
Okay, we've heard both cases. We've stress-tested the bull argument, and we've listened to the bear's warnings. I've laid out the evidence for an impenetrable financial fortress. The skeptic has pointed out what he believes are fatal flaws in the foundation. Now it's time to weigh it all. It's time to cut through the noise, look at the hard facts, and deliver the iron financial verdict. Is Moody's a company built of steel, or is it just a pretty facade waiting to crumble?
So let's put it all on the table, side by side. On my side, you have the deep, structural strengths of this company. You have a business that's shifting to almost 100% recurring revenue in its fastest-growing division. You have margins that are getting wider, which shows they're becoming more efficient. You have a management team betting billions on their own stock. And you have this huge, untapped growth engine with AI integration. These are the steel beams of the company. Go ahead, skeptic, what's on your side?
And on my side, you've got the real-world risks you just can't wish away. The old business is still a huge part of the company, and it lives and dies by the bond market, which is famously unpredictable. You have a laundry list of economic problems on the horizon that the company itself admits are coming. And on top of it all, you have the market, which is overwhelmingly negative on the stock, and that kind of sentiment can be like a lead weight for a long, long time.
Our verdict is clear. We believe the market is making a fundamental mistake.
It is focusing way too much on the cyclical risks of the old Moody's and almost completely ignoring the structural strength and durability of the new Moody's. The fear about a temporary dip in the bond market is completely overshadowing the fact that this company is turning itself into a high-margin, subscription-based data machine. And management not raising their guidance, that's not a sign of weakness, it's a sign of being smart and cautious. Their actions, that massive $2.5 billion buyback, that's what you should be listening to. The gap between the stock price and the business performance right now is a genuine structural opportunity to buy a world-class company that the market just doesn't understand.
But listen, that's the analyst's verdict. He sees an opportunity that's forged in steel. But I'm going to leave you with one final question to think about. The market is a powerful force, and all that negativity can hold a stock down. And those economic storms I talked about, they're real, and they're coming. So before you do anything, you need to do your own homework. You need to decide for yourself if this is really a fortress that's on sale, or if it's an iron trap perfectly baited with one great quarter just waiting to snap shut on anyone who gets too close. As always, the final call is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.